Please welcome Danny Crichton, Managing Editor of TechCrunch.
Penultimate session here at the Tough Tech Summit. We're on day 2, the second to last panel of the day, on a topic that it could not be more important, the climate investing landscape. Obviously, an enormous amount of stuff is going on. Elon Musk is worth more than ExxonMobil these days. We've got COP26 just in a couple of days, and there could not be more news going on in the ESG and climate investing world. And that's why I'm so excited to introduce our 3 panelists today for I think it's going to be an extraordinarily interesting topic. So we have Katie Ray, founder and managing partner of The Engine, Rick Needham, partner and energy lead at the Rise Fund at TPG, and Jigar Shah, the director of the Loan Program Office at the Department of Energy. Folks, I'm going to start, I'm going to start with Katie. Obviously, there's a lot of different types of capital coming into the markets. And when we talk about climate, there could not be, I think, a wider bucket of tools for raising capital for founders today. There's seed funding, growth funding, double bottom line, debt products, the list goes on. What are you seeing in the market, and how is the engine sort of supporting companies financially these days?
I mean, obviously an incredibly exciting moment for climate tech companies, right? In days past, it might be that you crawl along the bottom of the earth for 3 or 4 years and run a few experiments. And now you can actually think big really, really quickly. And that's great for our planet and great for our entrepreneurs. And, you know, obviously for those of us in this room, also hopefully great for the investors as well, right? We are betting on things that have an enormous impact on reducing carbon emissions or sources of clean energy, which also reduces carbon emissions. So things that are really, really important. And if those companies can go further faster, we all end up winning. And so that's, I think, lots has happened over the past 5 years around pricing in climate change, right? The more flooding, the more fires, the more understanding that climate change is real, everybody starts to see how it's going to impact their entire portfolio. And therefore, companies like this in climate tech that can be global scale become very, very important. And so I think I welcome all the new types of investors. I think everybody's going to have to get a handle on how you invest in these types of companies and what the true progression steps are to be at global scale. But, you know, you have to think that there are going to be a lot of smart people investing here and that we're going to learn really quickly. So I am very optimistic, and you know, I am paid to be an optimist. I'm a venture capitalist, but I'm optimistic, and the people that I'm meeting every day that are forming new funds are really, really fun and very committed to reversing climate change. So.
And Rick, you're obviously with the Rise Fund a little bit later stage than the Engine, and also a double bottom line or a global impact fund. Could you talk a little bit about your focus and the kinds of companies you tend to invest in?
Yeah, thanks, Danny, and appreciate you being here today with these esteemed panelists, Katie and Jigar and yourself. You know, I think we do invest later stage, so we're investing in like growth stage companies, ticket sizes of 100 to 500 million or so. So certainly later, but we're seeing opportunities across all these sectors that relate to mitigating or avoiding climate change, mitigating or reducing greenhouse gas emissions. Our latest fund, the TPG Rise Climate Fund, is really looking at, I call it 5 main sectors. So, and they're probably the cast of characters that everyone knows about, clean energy, decarbonized transport, kind of greening of industrials or lower carbon industrials, food and ag. And then, I think there's some connectivity, some fabric in the 5th one we call enabling solutions. There's things like carbon markets, or it's software plays that can help all those other sectors. But to Katie's point, I think we've seen a massive shift in interest and attention to this, and it's to the wildfires, the flooding. Like, evidence is not only all around you, it's no matter where you are on the earth today, it's like literally punching you in the face, right? With I think weather damages totaled, increased like 8 times over the last, several years. It's massive. So we're seeing attentions from governments, attentions from corporates, attentions from consumers. All of these things are coming together. At the same time, very importantly, costs have been coming down for some of these solutions. I think Lazard just put out their LCOE report literally today, and newsflash, costs went down again. So it's not like this is kind of a normal thing, but the competitiveness of these solutions to other ones is becoming ever more present across more and more geographies. So now it's not just the cheapest form of energy. Renewables aren't just the cheapest form of energy to build. They're actually cheaper than operating existing fossil-based plants. They beat coal handedly almost everywhere. They're starting to beat gas, but it's this cost down at the same time as attention to the climate has come up, which has formed this unique time where you're getting all these additional investors coming into this space, recognizing these are not markets in the hundreds of millions or billions. These are literally trillion-dollar markets that we have to solve. We just have to solve them. So there's a sense of we need to do this. There's not enough capital coming at them today. And there's going to be enormous opportunity. But just like Katie, we are optimists. We think there's a lot of opportunities. The teams and the talent forming around these ideas and companies have been phenomenal. We love meeting with them. They're motivated. And we're super excited to be a part of the ecosystem, helping to scale up great companies solving climate.
Well, thanks, Rick. And Jigar, you've been on both the private and the public sector. So before you were in government, you were the co-founder and president of Generate Capital. And I'm curious why the switch from the private sector into the public sector at the loan program offices at the Department of Energy. And could you talk a little bit about what you invest in at DOE?
Yeah, thanks. I mean, as Katie suggested and Rick said, we're talking about $1 trillion scale, right? So we invest, let's call it $3 trillion a year, very conservative number. Most people think it's 2 to 3 times that into infrastructure. But just, this is the infrastructure that we talk about when the president calls about Build Back Better. And, when I was at Generate Capital is a fantastic firm, but we're talking about, $1 billion of deployment a year into catalyzing something, right? And, I think today the federal government is playing this complementary role to the equity investor. So with all these companies that are SPACing and, getting ready to do an EV manufacturing plant or a battery gigafactory or a green hydrogen facility, et cetera, when they turn around and go to a major money center bank and say, we would love to get debt, please, the bank says, what are you talking about? You haven't been profitable for 7 years. You're not actually like a company that we bank, right? Go build this stuff 100% equity. Well, you can imagine that without having something like the loan programs office to give them commercial debt, there's no bridge to bankability. There's just equity, right? And I think when you think about where we need to move and how fast we have to move, I made the decision to move from the private sector to the public sector because I didn't see a partnership between the private and public sector. I saw a bunch of folks, including myself when I was on the private sector side, that never visited the Department of Energy website, that never figured out how to partner with the federal government, except for maybe getting some tax credits passed through the legislature. And now when you think about what the Loan Programs Office has done, we created $1 trillion markets in solar and wind in 2010 when no one else wanted to bank those assets, and in EV manufacturing, as we just discussed with Elon's net worth. And now we've got to do that in 17 more sectors, right? To be able to have a chance to meet the decarbonization goals in 2035 for the electricity grid and the entire economy in 2050.
Well, I think this concept that you've proposed, which is this bridge to bankability, I think gets at something really fundamental that's challenging in a lot of climate industries, particularly energy, where first you have sort of basic science research that creates new products, a productization phase to try to get it commercial. And then you have the scale up of how do you get from one deployment of, say, a piece of a power grid or a power generation plant to multiple, to hundreds, to thousands all around the world. I'm curious from everyone's perspective, and maybe we'll start with Jigar, and anyone who wants to follow up can do so. Where are the bottlenecks today when it comes to capital for startups?
Well, I think we have to define, who deserves the money and when, right? I think that, when you're in the phase of demonstrating your technology, you're really not yet on the bridge to bankability. right? The first part of that bridge is a first of a kind deployment at commercial scale. And the vast majority of companies who get A rounds and B rounds are largely proving out their technology, making sure that the incremental innovation or fundamental innovation that they've done actually works, right? And then, you might make it work at lab scale, you might make it work at 1/8 scale, but when you actually want to make it at scale, it's, sometimes $100 million, sometimes $500 million, and sometimes $1 billion, right? That's a big number. And that's the first step on the bridge to bankability. First of a kind deployment. It requires applied engineering, a bunch of people who says, I know this will work, but here is how we'll do it for the first time. Then you've got a bunch of EPC contractors who say, I think I can do that 25% cheaper by optimizing all of these processes and all that stuff. And then you've got the learning curve, right? This is starting solar at 17 cents a kilowatt hour and now having solar below 3 cents a kilowatt hour, just learning by doing, getting the manufacturing process to scale, right? Building your 8th gigafactory. And then the fourth piece, which is the most amorphous, is then entering securitization markets, right? Getting the bondholders and all the traditional holders of the $3 trillion a year to be like, this is an asset class. We can just own it, right? And hold it forever. And that's where the solar and wind industry are now, where you've got folks that are buying that paper at 1.5%, 2% expected rates of return, right? That's the bridge. And I think a lot of folks are saying, well, we need help, sort of even understanding where the bridge is located, and then driving up to the bridge.
Well, I think one of the things, if I can jump in here, that I think is so exciting about today is think about fusion energy, right? So we just proved that Commonwealth Fusion's magnet can get to 20 Tesla and theoretically can be net positive energy in fusion, right? And now the private markets will continue to build the first tokamak system, and then we'll build the first commercial tokamak system. So that's 2 large systems away. I think even 5 years ago, it couldn't have been done in the private markets, right? It would have taken the public sector, the government, to do this. I mean, that's why we have ITER, right? And but I think there is the wherewithal today if you can prove the technology can work. And because the solution, if you get to scale, can be $1 trillion company. And I don't say that lightly. It's an enormous market, and it's a source of energy that is clean and very inexpensive at scale. And so that is the difference, and that's the excitement we are seeing, not just in fusion, but you're starting to see maybe theoretically also in deep geothermal, which is another enormous energy source that is very promising. You're seeing decarbonization at scale in things like, paper and chemical industries. And, so we are demonstrating that some of these technologies really work. But Jigar makes the most important point here. That's only the first bridge. And so it is private capital through the demonstration plants and then the scaled up demonstration plants until you can get to government loan programs or, truly low cost private market capital. And so that is why it is important that more and more people come into this market so that these companies have a chance to scale and have the impact we all want to see. It is different today than it was, and really exciting.
Maybe I'll, Danny, hop in real quick,
please.
just because when we've looked at this market, I think Jigar paints it's a great framework, because companies need to prove their technology to some level, then they need to prove it at some scale that could be commercial, then they need to go deploy at scale, and eventually get to the Shangri-La of securitization. But what we saw when we formed Rise Climate is there is this gap between proving out the technology, so the tech risk, and then there's the scale-up risk. And traditionally, these, to the entrepreneurs on the call, there've been challenges in finding that next level of capital. right? The banks that Jigar talks about, they weren't willing to finance. There wasn't a lot of capital ready to deploy. What ended up being that the route was typically sell to a strategic or get acquired by a strategic. Like that was the only kind of path. And if you ask those entrepreneurs, how did that go? From several years ago, invariably they say not so great. They got put in some corporate umbrella. The company didn't achieve what they wanted to achieve. And so this is one of the reasons of founding Rise Climate, which is we needed to provide a slug of growth capital to those companies where we're not taking so much technology risk, but scaling risk. And that's something that we can help them do and scale the company and scale the products and expand globally and all that stuff. But it is a different time. Those solutions haven't been there before. We're seeing more investors come into the space at various parts of the stage of where they can be helpful. But what's really encouraging is that there are people showing up to this party. The party is real. The party has an ultimate objective of solving a big problem. But we're kind of excited now with all the entrants. But to Katie's point, people have to be comfortable and understand these markets. They're not easy ones to just hop in, say, I'm going to do climate investing and just start throwing money at things. You really need to understand the science, the engineering, the applications. There's a lot of nuance in kind of each of these market areas, each of these sectors.
I just try to buy a thorium power plant every single day just to cover my investment portfolio. But I want to talk a lot about this inflow, because I remember a couple of years ago at TechCrunch, I would try to cover climate and there was literally no one out there. I mean, some of you folks were getting started in different places. There were a couple other folks, obviously, who are not on this panel who were doing it. But it was a pretty quiet world. We could probably sit around a large dinner table and kind of know everyone. And today it seems like there's thousands of folks. And I'm curious from each of your perspectives, what is driving that? Is that the entrepreneurs pulling capital to them? Is it that limited partners are sort of changing their investment mixes and are pushing capital into these markets? What's sort of changing and increasing the interest in climate investing today?
Maybe I'll take a quick stab at this.
Please.
We've seen three things, really four things maybe. So there's attention from governments. If you talk about like how much of the world is covered by net zero pledges, it was like maybe 16% in 2019. It's now over 70%. You can argue how valuable is a net zero pledge? Well, there's at least there's an intentionality there and some potential tailwinds. There's also the corporates that have become quite attuned to acting as good corporate citizens, but also thinking about sustainabilities of their business, not just from a sustainability point of view, but really a climate risk, transition risk. And so they're making efforts to. So if you talk about net zero commitments from corporates, that's also grown in a similar way that the kind of global net zero or carbon pricing mechanisms have grown, like to the tune like companies owning over like 11 trillion in revenue now have net zero pledges. These are real. And then there's a consumer point of view where I think consumers have also become more attentive to this. Again, to Katie's point, you're seeing it everywhere. It's wildfire, it's flooding, it's literally punching you in the face no matter where you are. So you see that. But the fourth thing, again, that's really important is this cost down along in a number of these areas where now you can actually have solutions that, people talk about a green premium. In some cases, there's not a premium. It's actually a cost savings, which is a positive thing. And those are markets that should just scale as quickly as you possibly can. I know Jigar has talked about this many times in the past, like solar, like what are we doing? These things are actually competitive today. We should just scale the heck out of them. And so all those things are coming together, I think, to bring us to a moment where people recognize there's something that we have to do, we can do it. And it's actually something that we really just have to do. And investors haven't been really kind of fully into and understanding all the solutions that are out there. And I think this attention is coming. And now we've seen our LPs, we've had to bring them along the path to show them the things that are possible. And now we're getting a ton of interest. I mean, there's a ton of investment interest now.
There's also maybe two other trends that I would love to add. And Rick, I agree with you completely, but maybe some other important things. One is if you talk to any student today, where they want to put their life, so many want to be in reversing climate change or making a real impact there. That's driving universities to make pledges that are really exciting, but also to push into technology areas that matter. So you're seeing kind of this bottoms up from the next generation. And that's forcing a lot of conversations at the university level, which are really big LPs, right? So you saw Harvard's pledge, BU, Dartmouth. You're going to see a lot of people pledging their limited partner dollars. And these are very large endowments that are typically thought leaders. And there could be some criticism of that it's not the right thing to do. But I think no matter what, it will drive the right kind of dollars into climate tech. And so I think you'll just see things accelerate from here.
Yeah, I mean, just one other thing I would add, those great points is that the concept of a green premium has already been debunked, right? It doesn't exist. It's called a tech premium, right? And it's the same with computers and the same with cell phones and the same with everything else, which is that the first unit costs a lot, and then it comes down with a learning curve exponent. And for whatever reason, very seemingly smart people didn't actually understand that this was true in climate tech. And so when solar power was at 17 cents a kilowatt hour, people were like, well, it's always going to be expensive, even though everyone was saying that with 6 cumulative doublings of experience, we'll get to this price. They're like, I have no idea what just came out of your mouth. I don't know what you're saying. Right? And the same thing's true with electric vehicles. They're like, oh, the Model S is $90,000, right? That's never going to get cheap. Oh, crap, I was wrong about that too. The battery storage is going to be $1,000 a kilowatt hour. That's never going to get better. Oh, wait, what? It's at $200 a kilowatt hour? And then, it happened with wind. And then people are saying, wait a second, is this actually a trend? Could this actually be a fundamental law of science that we invented in the 60s? And then now people are saying, well, this actually could happen over and over again. And so investors start to say, actually, it's not a bad thing if the technology that I'm investing in now is too expensive for the market. The question is, are the underlying fundamentals of that technology subject to the learning curve, right? Like, for instance, when you think about the AP1000 nuclear power plant, right, that's an airport, right? But if you build nuclear plants like airplanes, where it's actually the same supply chain and you're doing it over and over again, like small modular reactors or micro reactors, you could see the same learning curve applying there as opposed to airports like, the AP1000. And so where people wrote off nuclear in the past because they were saying, oh, like it gets more expensive with learning, which is what was happening with central large-scale nuclear plants. Today, you saw announcements by Rolls-Royce on the SMR, by EDF in France on their SMRs. You've got the Canadians making their investments, and the United States will be making a lot of investments and announcements there too, because we've got the best technology in the world in that area. And so you start to see just this pattern recognition from investors, which then allows them to have more confidence in moving into these sectors.
And I also think you have the entrepreneurs. Every entrepreneur I meet today, or most who are doing a climate tech play, know that I'm going to ask about their techno-economics. Like, what does it cost? What does it cost compared to everything else? And how does your cost curve come down? Like, that is in the first pitch when they're coming out of a university lab. So that wasn't true in the last generation of these kinds of companies. And so we're getting better. And you saw this in Web 1.0 versus Web 2.0, right? You couldn't just sell pet food at whatever cost. You actually had to make it work economically and have the right scale. So you see that here too. And that's what makes this generation of companies really, really exciting.
Well, obviously the costs are coming down quite significantly. I want to direct our attention to commercialization, because I think that's one of the big bridges that can oftentimes be a block, particularly for first-time founders entering the climate sector for the first time. How do you get those first customers? How do you get those deployments in place? And I'm curious because I think 10 years ago, the criticism for a lot of climate and energy investing was, well, there aren't that many customers. It's really hard. It takes 5-7 years. A POC, can take up to a decade, and it's hard to get the kind of feedback that you're used to in, say, softwares or services where you can rapidly iterate on the product. I'm curious, in the last couple of years, as there's been a lot of acceleration, what you're seeing that makes commercialization faster for startups today.
Well, I mean, one of the things I would say is that it took a long time for the power purchase agreement to take off, right? I mean, I think as Brian Janis said on the My Climate Journey podcast last week, for Microsoft, he said, Ballmer was completely against it. And the new, folks came in and basically said, we'll sign these corporate power purchase agreements. And then, it was a slight premium, and it came down in cost. Today, when you look at these kinds of companies, they're starting to lean in on contracts for the circular economy. They're leaning in on, electric vehicles for their delivery vans, for fuel cells for their forklifts, and their, and signing contracts for those. And so, and now you've seen huge announcements from the major airlines for sustainable aviation fuels. So you're starting to see that the pattern is becoming more clear to people, right? The pattern for this tech is pretty clear, right? There has to be some understanding that the technology will actually work, right? That's point number one. Then it's what's the feedstock, right? Are you going to get enough of it? For solar and wind, it was kind of easy, but now for circular economy or recycled batteries or whatever it is, there's a little more work to be done there. Then there's the offtake agreement. Who's going to buy this stuff later? Is the price fixed? Is the volume fixed, right? And then the last piece, which is the hardest piece for everybody, is can it be maintained? Are you going to actually keep it running at a high utilization rate for 20 years? Who's going to do the maintenance? What kind of dashboard do you have? Do people have the skills to repair this kind of thing, right? And so when you think about that equation, people are starting to figure it out. And so a lot of the Fortune 500 companies go to these conferences and they start to say, well, this thing isn't going to build itself, right? I mean, we're not going to build a renewable natural gas plant here or a green cement facility or whatever it is, unless you agree to build your data centers out of green cement, right? Or unless you believe you're going to do this thing. And then a light bulb goes off in their head and they're like, yeah, you're right. If we want this to happen, we can't keep investing in the technology because the cost curve comes down through deployment. Right? The cost curve doesn't come down through R&D. It actually comes through deployment. And so we are going to have to step up and actually help buy the first, direct air capture, credit ton or whatever it is that they have to do to do that. And I just think that realization wasn't there just 5 years ago.
I do think, sorry, go ahead, Katie.
Just 2 seconds and then jump in. One of the things that just to pile on what Jigar was saying is they're not only adopting the technology, they're also forming venture funds that invest so that they can help them even get to the point where they might be the first deployment. So that's, you see Amazon doing it, you see Google, you see lots of these Fortune 50 companies doing this, and universities are going to do it as well. And and the government. So between all three, you get a lot of adoption, which pushes commercialization. Do we have the workforce yet that's going to be able to maintain these? No, we don't. And there's going to be a lot of job training on that. But that's also a great sign. They're going to be awesome jobs, right? And what more do we want? We want, great technology that will reduce carbon and a great set of middle-class jobs to maintain and build these things. So, all of these things have a beautiful cycle with them, which is why I think all of us are excited to be in this sector. So,
don't forget about the local supply chain, Katie.
Oh yeah, and that too.
Yeah. So I do think that this is just one of the vectors I mentioned of why we're at this point today, which is the corporates, which in many cases the buyers are the corporates, and the corporates have been making these pledges, net zero pledges, science-based target initiative actually just released yesterday, here's actually what a corporate net zero commitment should include. And it's 4 things. So there's there has been a bit of making these commitments. There's a bit more granularizing those and understanding what are the elements that really make a true commitment. But I think these companies understand, and this gets to what Jigar was talking about, there's companies involved in materials. So fast moving consumer product companies, they're looking at how do I replace some of these, materials that I don't want, plastic that's not based on petrochemicals. How do I think about replacing I used to work at Google. For Google, Microsoft, Amazon, one of their main ingredients is power. How do I think about renewable power? And going through the process of thinking iteratively and thoughtfully about this, like I'll do it if it's cost neutral, to now, oh my gosh, I'm seeing it's actually cost advantage. And then they can make even more aggressive goals. Google coming out announcing, we're not going to be, neutral. We're not going to offset through renewables. We're actually going to go 24/7 everywhere in the world we are with renewable power. They could not have, they don't know exactly how they're going to get there, but they know it's a lot closer to happening now than it was 3 or 4 years ago. So I think these commitments that the companies are making, and frankly, they're going to be held to task by not just the market, but their employees. To Katie's point, all these young people joining these companies, that they want to work for companies that are really meaningfully and authentically going down the path to a better, more sustainable solution in whatever service they deliver. So I think the customers today are more sophisticated. They're actually pulling these solutions. We think about the circular economy, like the Nikes of the world. They're probably trying every single thing they can think of. They're working with every company they can to deploy some of these innovative solutions and materials into their products. And if they find one that works well and they're going to scale, they're going to buy a lot of it. These are big buyers of some of those things. So I think the customers are, much more attuned to what does it mean to have sustainable inputs. They're very actively looking at those, and they're willing to sign purchase orders if they get one that's right. And so no better time to be an entrepreneur to really be delivering true solutions. The customers are there, they're lined up, they want to buy.
Mm-hmm. And obviously the climate investing landscape is very large, encompassing everything from energy to agriculture and food to material science, maybe into biotech as well. I'm curious, when you look at commercialization, where are some of the gaps? Are there certain sectors that you're very excited about the technology? You're starting to see some proof of concepts, maybe in the lab setting, but not in real life. But the purchase orders or that kind of infrastructure we're seeing in energy and some other categories maybe is a little bit more lackluster.
Yeah, no, I think it's a great question, and it's one that we're thinking a lot about, right? And so I would maybe say this a little bit differently, which is what is the truly American way to commercialization? I think we all have a guess for what the Chinese way of commercialization is, or even the European way that they do commercialization. And many of our startup companies have gone to China or to Europe to commercialize their technologies. And I think the secretary has been very clear that that is not something that she thinks is a great outcome for the government. And I think when you look at what the federal government has done, is that there's a couple of things that they're doing. One is that the president has suggested that the federal government should be the largest consumer of these goods and services, right? So to the extent that Rick was suggesting rightfully that the corporate sector has really stepped up, and Katie was suggesting that the universities and others will also be stepping up. I think the federal government is, about 22% of all purchases of everything in the country, and combined with some of the state governments who set policy on auto emissions or others, you can get a much bigger bang there. I think the second thing is that in the bills that are going through the Congress now, including the bipartisan infrastructure bill, which has already passed the Senate, there's $21.5 billion in there for the Office of Clean Energy Deployment. And that is this large grant program for demonstration of US technology, making sure that scale up from $10 million scale to $100 or $500 million scale actually happens here in the United States with US money. And then you've got the program that I'm running, which is the Loan Programs Office. And interestingly enough, the Loan Programs Office in the past, remember when it was successful in the past, it was really at a time when commercial debt markets had seized up, right? And so you basically had 20-year power purchase agreements, and it was fairly straightforward to fund that stuff, even though it did take real leadership on the part of the folks who led that program at the time. Today, we need a new set of skills, right? So there's merchant risk in many of the deals that we're looking at today. And there's 3 component parts, and we are rethinking the way that we do that. So in the past, the conditional commitment, which is the term sheet that's provided by my office, it was really the last piece of the puzzle, right, when you start construction. Today, we're coming in early. So we're first. We're coming in before the equity, before others. We're bringing the 10,000 engineers, scientists, and experts who are on the government payroll to opine on whether the technology will work and whether it will work when it's scaled up. And we're providing a conditional term sheet up front. that makes it way easier for the entrepreneurs then to raise the equity necessary to build that plant, right? And that's working really well. And then we don't close the loan until after they've raised the equity. So the equity raise becomes a CP to the close between the term sheet and the actual closing of the loan. And then we don't fund until they meet the CPs that they've promised, right? Whether it's putting feedstock agreements in place or other things that they've promised that they would do, that's when we fund, right? But it's a far more symbiotic relationship where the entrepreneur can say, here are the promises that we're willing to make. The government says, well, then if you achieve those promises, then here's the money that we will provide. And you start to break the chicken and egg cycle that American capitalism has created for these types of innovations to scale up, right? And that really serves as a uniquely American approach to solving these problems, where you do have some, large government involvement, but it really relies on the private sector to lead and to state what they believe they can do, and the government meets them more than halfway.
So let me jump in here for a minute, because I probably have a very different perspective to your question. So two areas that I think don't have enough investment are semiconductor, and you say, well, why is that in climate? Well, it runs almost everything we do, and if you can reduce the amount of power needed into everything, that's good for the environment. And then water. It's such a tricky space to invest into, and the economics of it, the technology, we really haven't seen anything come out of. And we all know water's going to be very important around the world, given how the climate is changing. So that's just from a very early stage perspective, those are areas that we still find tricky. And the semiconductor one is almost all the manufacturing is done in Asia. Now the US is working really hard with the CHIPS Act and a bunch of programs around that, but we certainly want to see that supply chain developed here. We want to see the innovation that is coming out of the labs here commercialized, and that's still tricky.
Rick, did you want to say anything, or do you want me to move on?
I would just those are, I think, from Katie's comments, those are certainly sectors that are tough. The sectors the areas that are tough are ones where the markets aren't clear. Like water is one of those ones where the market, there's not really, in many cases, a market mechanism that's logical. It may have evolved over time, which was smart the way it was set up at first, but it's very different. It's not, a traditional capital market. There are other ones that I think are just harder to invest in, where we talk about a lot of the costs have come down, like in power. There are other ones where, frankly, it's not quite there yet. The competing, unless you add a price on carbon, and if you don't, it's still very tough to compete. So those are ones that need early, innovation and development of the technologies to get them down to a cost curve where now it can compete. So to Jigar's point, the green premium, it doesn't really exist for power today. It's kind of it's a false statement, but there is still some sectors where it's difficult from an economic perspective, and that's fine. Those are ones we need to really hit hard with technology and advancements, and then be ready to scale. I know there are many companies in those hard to abate sectors, call it cement or chemicals or whatever, where there are solutions that are starting to come, and there are people who are interested in deploying those, and ag is another one. But I think to get those to scale, we need to, just like we did in power and batteries and likely in hydrogen soon, we need to get down those curves. So those are just harder to initially invest for us at scale because the technologies may not be quite ready yet.
I want to remind the audience that if you're on Hopin, you can fill out the Q&A. You can ask questions. We've got Michael behind the scenes forwarding them on to me, and I will definitely ask our panelists all the good and interesting ones you post in there. So please feel free to do so on Hopin. I want to go to the end of all the bridges, to the final bridge, which is the venture return. So obviously, everyone is looking to get their money either back in the case of a loan with interest, or in the case of equity, getting a full return on the investment that you put into a startup. And the exit market has changed a lot in the last couple of years, both because of rising valuations, but we've also had new initiatives like SPACs, special purpose acquisition companies, which have made a huge impact, at least from my perspective, in climate. And so I'm curious from each of your perspectives how you're thinking about the exit market today. Who maybe is acquiring these companies? Are the IPO lanes open? Are SPACs a legitimate source? What are you seeing there today?
I'll hop in. I think the exit path, we're always attentive to what are the possible exit paths for our investments. And I'd say public markets is certainly one avenue, whether it's traditional IPO, it's SPAC, it's direct listing, but basically the ability to bring a company public. There are obviously this is one of the biggest, climate energy is one of the biggest industries in the world. So there are strategics who are thinking, in some sense, existentially, like my business model isn't going to be the same in 10, 20 years. I need to think about where do I go? What do I do? And they may be acquirers of technologies, maybe things that can extend whatever asset base they have to enable them to participate in this new energy transition world. So there are potential acquirers there. And then there's, I think there's also sponsors, and I'd say folks who are more the infrastructure fund side, who would be willing to buy assets that get developed and they understand, I know how to run an asset. That, to Jigar's point, that may have not been an asset class before, but now I see it at scale. I see the 10th plant. That's an asset I can understand. So there may be markets and exits where you have projects that exit and you have platforms that then exit too. So I think there's a lot of potential here. They are bigger exits. I would say the SPAC phenomenon has been quite interesting, and frankly, probably a great injection of interest and attention to the space. That to my earlier point, these companies didn't really have great exit options. There was no real growth stage equity that was aligned with what they wanted to do, and so it was typically to a strategic. The SPACs opened that spigot up. We can all argue about whether some were actually ready to be public companies and if they thought about what their projections showed, but be that as it may, it certainly provided another avenue for companies to exit in some sense and to get the capital they needed to prove out their business models. And some are probably better prepared to do SPACs and some aren't. But I think we now have some private capital solutions. We have public capital solutions. We see there's certainly a number of exit scenarios where we can get the capital back and the returns that we need for our investors while also proving that the model works, where you can invest in truly impactful companies at scale and achieve both things: big impact at scale and big returns at scale.
Yeah, I'll jump in there too. From an entrepreneur's standpoint, they feel the pressure to be able to be a public company pretty early in a life cycle. There's some good and bad to that. I know you're asking about returns, but I want to bring it back to the entrepreneurs. Because in a way, it makes them think really big and really scaled, awesome. But it does add pressure. But from our standpoint, we just want optionality for them. Can they go public? Do they get bought by somebody? But we want to have optionality, but we want them to keep the focus on being a globally scaled company, right? So if we're going to put a ton of effort into a whole new area like fusion or deep geothermal, we don't want that to be bought and squashed. We want that to be bought and scaled if it ever gets bought or on the public markets itself. So we are thinking about returns, but we're also thinking about impact alongside that. So you have to balance those two things. And I think for the areas we're all investing in, there should be plenty of area for massive returns to our investors.
Yeah, the one other thing that I would say is that I deal a lot more in project equity, which sometimes comes through the corporate. But in that space, the amount of ease by which people can recycle their equity out of that position is remarkable, right? Because there's just so much infrastructure money. I mean, there's over $1 trillion raised into funds that really just are desperate to go somewhere. And so once it's been de-risked, like once a project gets through the construction phase and then maybe has a 1 year or 2 year ramp up, selling down that equity to somebody who has a much lower return expectation and realizing your gains is pretty straightforward. And particularly when that's mixed through the corporate equity lens, can be a great partial exit for some of those early risk-taking investors.
Your background in project finance is actually related to the first of a lot of questions coming in from the audience. So the first one is about the question is very long, so I'm going to try to summarize it. But I think what they're asking about is in project finance, one of the major goals is getting predictable cash flows, knowing that for the next 5 years you're going to have a deal with a corporate, a government agency for, so let's say, $5 million year over year, and that predictability allows you to invest in R&D, build the company, and continue to scale up the product that you're building. But obviously, over the last 2 years, we've seen a lot of variability and vagaries in the market. Obviously, with COVID, the supply chain disruptions, it obviously goes on and on with disasters in the climate world. How do you create predictability with a lot of these purchase orders when factories and others are constantly trying to optimize for the bottom line and consumer demand that's changing so rapidly these days?
Yeah, I mean, so you're never going to get a manufacturing plant that actually has a credit rating of, investment grade upfront, right? Because by definition, you have the purchase orders that you have. You're not sure if the next model that you create is going to compete in the market or whether someone else is going to outcompete you there. So, I mean, it's difficult. So by definition, the risk profile is going to be less than investment grade. But I mean, the Department of Energy's Loan Programs Office, we fund things that are CCC plus or B minus all the time, right? And so many of our manufacturing applications, we've had, I think, 3 solar manufacturing facilities that have come in expecting the OSOF bill to pass through the Senate. And then we've had a lot of EV charger applications, manufacturing applications, of course, traditional ATVM, the Advanced Technology Vehicle Manufacturing Program. So that's EV manufacturing, battery manufacturing, critical minerals, recycling, wire harnesses. I mean, so a lot of supply chain there. And so we do have the ability to fund manufacturing, and we do know that it's at a higher risk. But we actually have, not unlike other investors, we have a portfolio approach where we might say, well, there's a 15% chance of loss of this. We put that money away into basically a loan loss reserve for each one of the applications. And then that reserve should be high enough to cover all of the investments we've made. And to date, we've been too conservative, right? We've had 6 times the amount of money that we've lost, right? We've lost about $1 billion, but we reserved over $6 billion in those reserves. And so we've been over reserving per se in terms of the risk that we've been taking. And I think the secretary has been pretty clear that we should be getting more aggressive and getting the manufacturing built back here in this country. So I do think that is something that we're equipped to do within our program.
And Rick or Katie, are you seeing folks try to create better contracts in terms of stability for startups? Because obviously, it's hard if you're the last person carrying the bag as a small company to say, well, we didn't have the manufacturing order this quarter. You're out of luck. And oftentimes that can be very damaging when you're first getting going.
Yeah, I think we've looked at a number of companies and are about to invest in a company that builds a plant, that makes a product that people buy. It's very difficult to go just project finance that plant because of the variability in demand, the price, and all that. But what you can do with a plant and a production is you get customers signed up under contracts. They're typically for a product. It's typically not like a 20-year PPA. But frankly, PPAs have been shrinking in duration now, and now they're corporates are probably signing more like 10-year PPAs or even less, perhaps. So you're not having that long duration kind of contract, but you can get volume and price certainty and bands, including a minimum buy. So those things you can stack up. What typically would happen then is that company would raise the debt, right? So it's corporate debt raised on the back of factories that are producing products. So it's not necessarily project finance, but it's corporate debt. And if it comes with understanding what the EBITDA profile is of that company and the contracts that they have for the products that they're selling, that's the way to potentially finance some of those companies. I suppose over time, it's quite interesting because you could access local, regional, government-supported debt as well. So, like to Jigar's point, if they, I think there was an advanced vehicle manufacturing kind of loan program, right, where you could actually access some debt to go build out some of that manufacturing capacity. Where I think governments are recognizing like that support on the manufacturing side could be quite valuable to go build out that factory. But it's a different beast than contracted cash flow, right? So it's more complicated. And that's why when we've seen companies do more like corporate debt to do that.
Right, and at the very early stages, what we see are joint development agreements and or corporates doing purchases because they want the very first one, right? So those are typical things that you see at the early stages that bring on the next investment cycle. And they might be small, but meaningful, right?
I'm going to go to the next question, which is, I think, highly related to a challenge for a lot of startup founders, which is, how do you work with small companies? And I think this was particularly directed at Jigar and sort of the loan program offices, but I think it applies to all the work that we do in climate, which is, when you're only 2 or 3 folks, you have an idea, maybe you have a research project, a PhD student, finishing up in a laboratory. How do you get those early funding rounds and pieces to actually get the business underway and build momentum?
Well, I can start that part. I mean, I certainly think that the venture capital community does, is very supportive there. I would say from the government's point of view, you have a series of incubators around the country that we funded partially. And so many folks, decide to integrate there, whether it's Greentown Labs or many, many others. I think the second piece is that there are lots of easy ways to get money in the $300,000, $500,000, $800,000, $1 million range. So these are SBIR grants and research grants and funding opportunities and things like that we do regularly. And I think the government's good at that. And then there's also one thing that people don't take advantage of is there really are, there's over 110,000 people who work at the Department of Energy, but roughly 10,000 of them are specialty scientists, experts in the labs, et cetera. And they really do pick up the phone. So if you just call them, some of them have been working in that field for 30 years and they're happy to help for free. I think where there's a big hole in the way the government supports companies is in that $10 to $30 million check. And in that case, ARPA-E has provided money earlier, but then also through their scale-up program. I think they provided, the largest checks there are around $10 million or so. But I've certainly heard from people that they need $25 million to really demonstrate this last phase. And it is binary. And so a lot of investors don't want to put up the $25 million for the right to be able to get the riches on the other side. And so that is something that is a bit of a hole. I'd say where our office comes in is probably in that $100 million range and above. And so I know that part of the Office of Clean Energy Deployment, which is in the bipartisan infrastructure bill, is to help address that hole in the middle.
Yeah, and I think for early stage investors like the Engine, but many others, we often are partnered with the government at that stage and investing sometimes in binary engineering risk. But that's why we have a portfolio of companies, and not every single one will have to work in order to return, have really good returns to our LPs. But that kind of partnership with these really important technologies that, at least at lab scale, have proven that the economics work, and if you can scale the company, they'll have a huge impact. I think it is important that venture plays a role there, but we can't do it alone, right? Often that risk is really too big to do alone, and that's why we need partners, either corporate or government or both. Often it's both. And we kind of make it all work as a unit.
And I would just say, Katie is probably better positioned to talk about helping those 2 or 3 people with an idea to get somewhere. Like that's not where we're spending our time. We'd love the companies that Katie has found and nurtured, and perhaps with a loan from DOE, and say, "Oh, okay, great, we'll help scale them." But we're not really in the earlier stage game.
I want to change the topic to another question. So Obviously, we're all in finance. We're all trying to get returns. We're trying to get the best return we can. But when it comes to climate change, different technologies can have vastly disproportionate impacts on the future of our climate. In some cases, when it comes to decarbonization, it might help a little, a lot, comprehensively, depending on the technology or the product. And I'm curious, from each of your different perspectives, how do you balance financial return versus sort of that double bottom line on decarbonization or climate change? I mean, do you make a trade-off between those two? Do you try to prioritize one or the other? How do you think about, because those goals don't necessarily correlate every single time?
Yeah, maybe I'm happy to jump in quickly on this one. So the whole thesis behind the RISE Fund has been to have demonstrable and evidenced impact from our investments as well as the return. So the way we think about it, we don't think there's a trade-off. Straight up, like the whole thesis behind RISE Fund is to show there is not a trade-off. It's actually, for those things that are collinear, they're actually very self-supporting. And second, we kind of end up having a threshold of impact that it has to meet some threshold of impact beyond which it's great and it's very impactful. And then we make it a decision on investment returns and prospects for the company and risks and so forth. We've done that in RISE. We have a whole methodology that this is actually frankly important to me when I joined the firms. Like, I want to make sure we're really authentic about this and the ability to measure this in a meaningful way. Kind of developed our own methodology. We have a separate organization that now kind of runs the process of that called Y Analytics. But we've done that in the RISE Fund. For RISE Climate, it's a very similar process, but it's focused specifically on greenhouse gas emissions. So it's something we call our carbon yield. So every single investment we invest in, for every dollar of investment, it has a criteria. It has to avoid or mitigate some amount of carbon or greenhouse gas emissions. Beyond that threshold, it's good, we'll invest. If it doesn't meet that threshold, then it's not an investment we'll do. It could be an investment that goes to another TBG fund, but not for RISE or RISE Climate.
And ours is probably even simpler than that, right? It has to have the potential to have a huge impact and return. So again, we see no trade-off in those two, but we don't have a specific measurement because each one of our companies is so different, and not everyone can be measured just by carbon. So huge is how we think of it. And it's pretty simple. And they're not old enough or mature enough to have all the measurements yet. By the time they get to Rick, they should be able to measure this. Yeah. Sorry, Jim.
Yeah. No, I apologize. But one other thing I would say is that we need a lot of pathways to reach the goals that the president's laid out by 2035 and 2050. And so I think it's important for us to not get bogged down in saying, here are the top 4 technologies in terms of their impact on the climate, because we actually need all 300 to be able to make the numbers work. And I think that there's also going to be a diversification required. So even if today something looks great on paper, you could imagine there might be a 6x rise in the price of cobalt, or a 6x rise in the price of lithium, or something else that occurs that then makes an alternative pathway more likely to be successful. And so I think that we should be careful about not being too smart for our own good around being, this overly precise around cutting off other potential pathways to decarbonization.
Well, we just have a few minutes left. I'm going to do a little bit of a lightning round question for everyone. So obviously huge surprises out of the climate investing community in the last 10 years. Obviously Tesla crossing $1 trillion, a lot of other major milestones such as wind and solar now outcompeting oil and gas and much of the rest of the world. I'm curious, in the next 5 years, what do you think would be most surprising? It's sort of a prediction question, but what would you think is the most surprising breakthrough or crossover point that we should expect to see in climate in the next couple of years?
Well, I can start. I'd say that a couple things I think will be true in 5 years. One is, I think we'll be firmly confident in the renaissance of nuclear deployment within 5 years. And I think you'll see just an enormous number of gigawatts of mostly small modular reactors, but also microreactors that may not actually have been fully deployed, because 5 years is a pretty short time frame in nuclear, but I think they will already have been ordered. You'll already have the supply chain starting to be built out, and you'll start seeing deployment there. I think you'll also see a very clear pathway in terms of the decarbonization of airline travel. I think whether it's electric or hydrogen or sustainable aviation fuels, I think there is a commitment now to getting there. I think you saw the electrofuel stuff, the 12 folks and their announcement. So I think that you will see a level of commitment that I think is far higher than people thought. And I think the third piece, which I'm maybe more hopeful for than predicting, is that I do think that there is an extraordinary recognition today that we have completely failed. I mean, miserably failed on the circular economy, right? I mean, when you think about all of the minerals and resources that we just allow to leak out of the United States into Malaysia, and then the Chinese get copper from that or other places, like we are going to recycle all of our cell phones, all of our electronics, all of our batteries, all of those things here in the United States, because the minerals are just worth too much. Like, it doesn't make any sense for us to just bury stuff underground. And that's also true for plastics. I think it's true for clothing. I think it's true for a lot of things that we just discard and ends up being far more valuable than what's going through, because we are firmly in a commodity super cycle, right? I mean, we do have a structural deficit of commodities versus the demand that's coming. And so that means that we will be in an era of high prices for a long time for some of these things. And I think that will lead to an extraordinary amount of focus on the circular economy.
Well, Jigar, I appreciate that. We are actually out of time. Katie and Rick,
Sorry.
If you have predictions, post them to Twitter or post them in a blog post. I'd love to hear them more. But I want to thank all three of our panelists: Jigar Shah, the director of the Loan Program Office at the Department of Energy; Katie Ray, founder and managing partner at The Engine; and Rick Needham, partner and the energy lead at the Rise Fund at TPG and TPG Climate. Thank you all three for joining us. And please stick around for the closing remarks from Senator Ed Markey coming up next.